Well, welcome to the PACE webinar on what does causality mean. Thought this would be a good topic for a webinar because for years in discussing cost models and in more current years when we're looking at the profit analytics model, talking in terms of revenue and investment models, we use the word causality, and the question often comes up, what do you mean by causality? So we thought that clarifying that a bit might be a good topic for a webinar. To get started, we probably should start at the beginning. Let's talk about the purpose of profitability analytics itself. Again, basically with profitability analytics, we're trying to create a high-level framework that can be used to provide decision makers with comprehensive and accurate decision support information. So again, we're trying to set a stage and have a high-level framework within which we can develop good information to support quality decisions. To meet that objective, though, the decision support information has to reflect what you would call the truth. So the question then comes up, well, what is the truth? Again, it's one of those things that when we use it in everyday language, we think we understand what we're talking about. But when you come down to discussing it in this kind of a sense, you've got to basically try to define what it is based on what you are trying to explain. I mean, basically, truth's the property of being in accord with fact or reality. That's sort of the everyday language. You're saying something that corresponds with what you can see, what the beliefs are, and so forth. In profitability analytics, one of the things we, again, want to make sure people understand is that truth does not mean precise measurements. What it means is a fair reflection of the economic realities that impact the decision. I always like to talk about the kind of information you need. The information you need to support decisions is information that will send you in the right direction and it won't be the information that causes you to make a bad decision. It will steer you in the right direction. Okay, we ended that with measuring realities. Well, reality is, again, another subject you need to quickly discuss before we get into the causality. The realities that surround us are extremely complex. They're so complex that they're really beyond the capability of humans to fully understand. I mean, just things like, how does the economy work? How does the universe work? What kind of a diet will lead you to have a longer and more healthy life? How do you raise your children? All these things are pretty complicated, but we've got to live in a world where we have to deal with them. So what do we do in order to deal with them? We create models of them, our internal versions of what those external realities are, and we use them to guide our decisions and actions. We basically don't use reality to support our decisions. It's our perception of reality that we use. And that perception is created by the models that we use to represent that reality. We create models of reality by identifying what we believe are the key elements of that reality. And then we try to determine how those key elements relate to one another. So what are the key factors that go into impacting whatever it is we're looking at, and how do they relate to each other? Once we establish those models, as I mentioned earlier, those models are really used to guide our actions and decisions, not reality itself. If we didn't have our own unique models that guide our decisions and reality guided our decisions, we probably all do the same thing, but we see the world differently. And it's because of the models that we create of the world. Now, if we're to make quality decisions, whatever our models are that we use have to be valid. They have to be fair reflections of what that economic or what that reality is. That's where we bring in causality. Again, we talked earlier about creating models. We create models of reality by first identifying the key elements and then determining how they relate to one another. That's where causality becomes a driving force, is how the elements relate to one another and what are the relationships between them. We got to also always have our radar up that causality is not the same as correlation. The fact that every time I turn on a Detroit Red Wing hockey game, they get scored on, does not mean that it's my switching the channel to watch the hockey game that causes them to give up a goal. Again, correlation is not causality. We don't want to use correlation in our models. We want to use causality, measuring the actual relationships between things. The causality principles, again, a phrase that we've been using a lot. Excuse me. In these three documents, we got the conceptual framework for managerial costing, the profitability analytics framework, and the revenue management fundamentals, SMA. It was used 41 times. And the framework, they've done a great job of drilling down in a lot of detail in explaining the various parts of causality as well as just using the phrase. But again, it's key to understanding how profitability analytics works and to see how things that we do, the actual methodologies that we implement, fit into the profitability analytics framework. If we look at definitions of causality, we got the dictionary. Basically, it says causality is the influence by which one event, process, state, or object contributes to the production of another process, state, or object, where the cause is partly responsible for the effect and the effect is partly responsible on the cause or dependent on the cause. Again, like most dictionary definitions, that's really clear, isn't it? The IMA conceptual framework definition is that the relation between a managerial objectives, quantitative output, and the input quantities that must be or must have been consumed if the output is to be achieved. Again, that's correct, but it's somewhat outside of our normal day-to-day language. I always like to put things a little bit simpler. Basically, in building revenue cost and investment models, cause and effect relationships must be used to describe and quantify relationships that exist between the key elements of the model. And obviously, under causality, those cause and effect relationships have to be real. They can't be casual relationships. They can't be just correlation-based relationships. They have to be real. Another thing that we need to keep in mind when we talk about causality is causality is based on resources, how things actually operate in the processes, not money. Causality is not doing this costs this much money. It's doing this causes us to do this, which causes us to do this, which causes this. And at the end of the line, you hang some money on it so that we can understand it financially. So again, you want to keep in mind, causality is based on the actual linkage of resources, operations, processes to each other. Just a quick example of causality versus non-causality in doing models. I deal a lot with auto suppliers. And I've always found that their method of projecting and forecasting their revenue is like the little non-causality line I have up at the top. Basically, the customer gives them a forecast, they hang dollars on it, and that's their forecast. They basically don't understand how it's put together, how you get from wherever they are today till the future forecast, because the forecast is done for them. If it doesn't come true, well, you can't go back and see why it didn't come true. If you do better, you can't see what was better than you thought. If it's worse, you can't see what was worse. And you can't use that as part of a feedback for learning of how to do a better forecast later. You could do something a little more causality based, where you actually looked at what the world economic forecast was, determined how that drives what the the automotive's economic forecast would be, see how that breaks down and how it affects various customers of yours, see how that breaks into the impact on specific programs, and then be able to monetize those. And then when time goes on, you can see what was different than what you had projected. And how can you learn from that to be able to project better later? One of the things I found in the auto industry is that customer volume forecast is always way too high. And if you don't understand how it got put together, you can't make the adjustments as time goes on. You can't maybe see that they were overly optimistic on one of those forecasts, and you should maybe water it down, be prepared for what they say, but don't plan to be at that level and you'll be more effective. Again, you need to have some causal effect relationship underlying the projection process when you're projecting revenue in this case. Otherwise, you're just taking a stab in the dark. You're just grabbing what somebody tells you and running with it. That's not causality. Now, the conceptual framework lists 10 specific principles of causality. Again, there's resources, what's the management objectives, how do you define a cost, how do you look at the homogeneity of the different pools of costs that you distribute, measurements of capacity, what's work, how responsive are they to each other, integrated data orientation, but its traceability and attributability are the ones I want to talk about today. We need much more than an hour to get deeply into all these other ones, but the ones that I think are critical and often missing in the models I've run into over the years is understanding the traceability, attributability part of causality. You can sort of break causality into a couple of categories. There's strong and then there's weak causality. Strong causality is where the cause and effect in that input-output relationship can be quantified and traced using measurables. Things like hours, units, transactions, head counts. You can actually trace them. There's traceability there. You can actually see where the person's working. You can see the part the machine's making. You can see and trace the nursing care to the person who's a resident in a healthcare. You can actually trace the support of a vendor out in the field for a exhibit support company. You can trace it to the vendor at the off-site location. There are numbers that you can actually trace, transactions you can trace to link the cost or the activity to the reason it's there. Then there's weak causality, which exists where we can infer a relationship, but there's no direct quantitative measure that links them together. And that's what we would call attributable. The costs are attributable to something. This group of costs or this group of activities or this group of resources are attributable to that other subset of my business. I know they're attributable, but I don't have a specific transaction to trace them one by one to the items that make up that subset of my business. So again, there is causality. You can infer it, but the quantification is more difficult. So there's strong, you've got quantified factors that you can use to trace the activities and the resources. Weak, you don't have those, but you do have the ability to attribute it to those things in a little more general sense. Using causality, to me, the most interesting and the one that's most valuable use of causality is in projections. You use causality to project the results of actions being considered by decision makers, to forecast future results, support budgeting and planning. You use it to be able to see what the future would look like if you do certain things. And that's again a powerful use of causality. In costing, you can also use it to assign costs and resources. You can use it to take your support resources in order to assign them to the resources that actually support your cost objectives. You can distribute things like your human resources departments and your accounting departments down to things like your production people or your actually in the field service people. And then you can use causality to assign the operational quantities, the resources to the cost objectives themselves, to the objective, assign it to the customer, to the product, to the service you're providing. Again, you can use causality for that. I probably should correct myself. You should use causality for those things. And part of what it does in using causality, and I alluded to this a little earlier, and I'll repeat it again later, but if you understand how you're going to get from here to there, and it makes sense, and it follows the laws of physics, you will better understand when something bad happens, why it happened, and how you can avoid it in the future. And you can better understand why the good things happened and how you can make sure that you repeat those good things. I had a best CFO I ever worked for years ago. At one point, talked about the difference between a forecast and a plan. And a forecast is telling me where I'm going to be, and a plan is telling me how I'm going to get there. Causality helps determine how it is you would get there. It's not just a projection. It's not just we're going to do 10% better. It's how we're going to get from here we are to be 10% better, because we're going to do this. It's going to cause this. It's going to cause that, and so forth. So again, if you have that map, you can learn from it. If you don't have a causality-based map, you don't get that opportunity for organizational learning. I'll talk a lot about with examples of causality and cost models, and we can talk about after I'm done some of its uses in other areas. But in a cost model, places where the causality comes in is, again, if you're going to use a projection to determine what the total cost of a particular volume and mix of business is, you start at the bottom, and strong causality drives a lot of the resources. Depending on how large you are, how small you are, you will have more or less things that you can find where strong causality drives them. Those meet up with things that are fixed or budgeted resources. Just for example, a fixed or budgeted resource might be the number of people in your accounting department, which isn't driven strongly by your volume and mix of business until you get to a certain point. If you have a large accounting department, you might drive it with strong causality because you have certain points at which you're going to have to click over and have additional people or less people. Smaller organization, you're going to have those 3 people, 2 people for wide fluctuations in your volume, so they would be fixed or budgeted. But again, the volume and mix of business will drive a lot of resources. You can then monetize those resources to come up to your total cost. But keep in mind that the causality is dealing with the resources themselves, not the dollars. The dollars is tacked on once you determine what the resources are. There's also fixed and budgeted expense that come in monetized, which are basically just things that you decide you're going to do, or they're unavoidable, like your property taxes and things of that ilk. With your total cost, then, you can use both strong and weak causality to do the assignments we talked about earlier, to assign the cost to support resources and to distribute those support resource costs to the resources that actually come back and touch the cost objectives, or the individual items that make up your volume and mix of business. So you'll find both strong and weak in those areas. However, when you're deriving costs, when you're determining the resources required, when you're making projections, basically strong causality is the key to being able to do that. So if we look at the use of causality and projections and forecast, again, it uses operational measures to project the resources you need to support that particular volume and mix of business. Basically, picture a chain of events, number of actions that will happen continuously after, just as a natural result of the triggering mechanism occur. This is a simple example. If you have a distributor and he gets an order, it's going to cause a chain of events. If you get an order, that's going to require you to do order entry. That'll require pick lists be prepared. It'll require an order be picked, the shipment package, logistics arranged, the order be shipped, invoiced, and payment received. So each order you receive will derive this series of events. And you can use the number of orders to be able to project the level of work that'll be required at the various stops along the chain. It might be more complex in this chain. It might be a little less complex in this chain, but it is the triggering event that causes the chain of event. And the number of orders received is a way to be able to do that, which would come from your revenue forecast, which would have hopefully been based on causality as well. Here's an example that we'll go through. It's a bunch of things sort of randomly spread on this particular slide. But we've got uptime hours, and we've got different kind of costs that a manufacturing company would incur. It's operating supplies, purchase maintenance, gas costs, electricity. You've got the cost of labor, both production labor, both straight time, overtime percentages. You got health insurances, unemployments, and payroll taxes. You got paid vacations. You got all kinds of costs. But the elements on this particular slide are not disassociated with each other. They're all connected by causality. They're triggered by those uptime hours. And if you understand the relationships and the causality, you can capitalize on the ability to come up with realistic projections, or as we used to like to call it around my firm, projections that don't break the laws of physics. Here's sort of the factors that fill in between those boxes. You got uptime hours. Uptime hours would drive things like operating supplies and purchase maintenance. That can be turned into a cost per hour of uptime. It determines things like electric and gas consumption, which would be the units, the BTUs or kilowatt hours. And then once monetized with the cost per unit, would arrive at electric cost. The uptime hours determines the production labor hours that are going to be required. Basically, you got your uptime hours of a piece of equipment. You multiply that by the crew size and then bump it by a thing we call indirect activity allowance. It might be an efficiency factor. It's basically the difference between what your theoretical labor hours are and what you actually incur in labor hours over time. And then with one more factor coming in there, all these other things would determine what the costs are of your employment-related costs. Headcount determines the difference between whether you're going to work overtime or have more people, which drives a lot of these other costs. So again, the change in uptime hours will change all of these other numbers in relationships of cause and effect. Just for example, I put some numbers to it to give as an example. Here we've got a case where we got uptime hours of 10,000. The gray, if they show up the same color on your screen as on my screen, numbers are basically the calibrations that you can make in your models for the relationships between the factors, again, between the uptime hours and the production hours that can lead to the cost of those hours. If you have 10,000 hours, you have a crew size of 2, that indirect or efficiency allowance is 40%. It tells you how many hours you need. You can match it against how many straight time hours are available, what the cost is per head, what the costs are as a percentage of wages. You can derive the other cost of equipment. And so you can see here that using this relationship, we could easily and following logic causality project the cost if something different happens. So let's say we go up to 12,000 hours. If we kick it up to 12,000 hours, causality tells us that we're going to work a whole lot of overtime if we don't have a few more people. So we're going to have to bump our production to 17 to keep our overtime percentage down within a level that we want to keep it. But as you can see from the cost over on the lower right, where we have the total equipment cost and the cost per hour, as well as the total labor cost and cost per hour, it's gone from 50 bucks an hour and 47 bucks to 45 bucks an hour and about 47, 48 bucks. Again, the labor hour didn't change much because our labor profile is about the same, how much they work straight time and overtime. But our volume is up. We can see the difference in the incremental cost of running these things now that the Equipment hours are higher. You can see we've gone from about $1.5 million to run the equipment and the production up to about $1.2 million. You can see the extra 200,000 that was caused by that. We can look and see, because we understand the chain of events, we can look and see if there's places we can make improvements. That indirect activity allowance that shows on there, the inefficiency, 40%. What if we could make it 20? Is that an area for improvement that we should address? Well, we bump it down to 20. Again, we can get our head count down to 14. And if you look down at the production labor cost in the lower right-hand corner, we can drop it from $47 an hour to $41 an hour. We can look at what the incremental impact is. If we do that and we're making a forecast, it'll take it into account in the forecast. And again, the whole idea is that there is a point at which there's an item that drives the cost using causality that goes throughout the organization. So again, you can find these kind of things in organizations in order to be able to better do the projections. You also need to worry about whether you got the capacity to do it. One of the little corners of the investment model would perhaps look something like this. We've got 3 scenarios for our company. In all of them, we've got start out with 4 machines, 2 shifts in operations, about 7.5 hours per day gives us about 21,900 hours a year, theoretically. But then we look at the fact we don't work weekends. We've got holiday shutdowns. We're down for maintenance. The actual hours available each year under that particular configuration is about 11,160. So what this tells us is that under this structure, we do have plenty of capacity to do 1 to 3, but we're short on scenario 2 because we've got a causality model, and we can say, okay, what would happen? What would be the best way for us to go and then provide that extra capacity? We could change and buy another machine or dedicate another machine to it. We could work some weekends on scenario 2B. We could bump ourselves up to work 8.5-hour shifts instead of 7.5-hour shifts, and we'd have enough. Each one of those then would have an impact back on what the cost is. And you can, with causality, you can run your the cost part of the model, match it against the capacity model, which can then come back and feed the cost part of the model, because you have all these cause and effect relationships. One of the things I like to point out to people is that we got interested 20-25 years ago in making sure we had causality built into models that reflected the physics of actually the operations we were running. When we began loading a lot of our clients' plan information into our models and found out that they were actually violating the laws of physics while putting together their plans, because their plans didn't have a causality-based structure where they could see when the impact, and you push your finger in over here, it bulges out over here, you better take care of that as well. Otherwise, the entire thing it becomes fairly meaningless. This kind of driver causing things isn't just exclusively in a manufacturing example like the one I just went through. This is from a long-term care facility we worked on a number of years ago. We basically say, what is the causes of their cause? Well, basically, you go back to the beginning, it's the volume and mix of residents you have and what their acuity levels are. That drives the need, in this case, for nursing services. We've got 4 categories of residents, go from subacute, dementia, skilled nursing, and assisted living. And within subacute, there's 4 levels. Within each of those, there are actually studies that tell you about how many registered nurse versus licensed practical nurse versus nurses 8 hours are required for each one per day. And you can use that same process of causality to be able to project the need of how many nursing hours you would need of each type. It's interesting on a capacity standpoint, one of the places that we actually built a model like this, the capacity for nurses was the local market. Is there enough nurses to meet that demand in the marketplace that you have? And it gets complex on how you provide them, because you have nurses that are full-time, full benefit, part-time, full benefit, part-time, half benefit, lots of categories. But again, there's a causality relationship that you could follow if you want to have a meaningful understanding of what's going to occur. You can also use those drivers to drive other things in a nursing home, those initial resident days, drives things like laundry services and dietary support services. It's a different level for each kind of resident you have. So again, that's how causality can help with projections. Again, reason causality is important is it ensures you take into account the most critical factors that lead to an outcome, and that you don't take into account those that aren't important. You basically have identified the key factors and you've been able to measure them and look at the relationships. And the critical to the whole thing is it provides a roadmap for spotting factors that can be modified to improve performance, or you can see what went wrong as you as time went by when you don't meet the projections, and you can act upon those to improve the results. I've had people tell me over the years, the complaints is, Doug, a lot of these things are difficult to project when you make a decision. My answer is always, you do project them when you make a decision. You just don't do it consciously, and you don't put it down. If I'm making a decision to do something with no information, I am making some assumptions. It's just when they don't come true, I don't know what they were, and I don't see where they went wrong, and I can't learn from it in order to not make those mistakes in the future. Again, it's better to estimate the things you got to estimate than to not do it because they're hard to estimate. Otherwise, you don't have a learning mechanism to get better at it in the future. And there's also the cost using assignments. One thing to keep in mind is when you do incremental cost analyses, assignments are irrelevant. The analysis that supports most type of business decisions is an incremental cost analysis. You just need to project the cost. Now, what is the difference? What's the delta? You don't need to worry about assignments. Assignments are only required when you're trying to figure out the total, how you distribute the total resources, so you know the cost of a function, how you execute a process, the cost of a particular product or service you deliver, or how to serve a customer over time. That's when you need to worry about the assignments. But incremental cost analyses, again, which are most cost analyses you need, are incremental. Assignments are not required for those kind of analyses. Again, causality in measuring incremental cost is just the left side of that diagram that I showed you earlier. If you're looking at incrementals, you don't need to worry about the right side. Using causality and assignments, again, you can use the strong causality when there are actual measurables that you can use to distribute costs. If you have human resources and you want to distribute that among the various other resources in your company, headcount makes perfect sense. Building and grounds, you could use square feet. Equipment maintenance, you could use equipment hours. Supervision, headcount of people supervised. Now, this isn't to imply that the relationship is linear. If you have two more people, you don't necessarily need to have two more people's worth of people in human resource. Your headcount goes from 100 to 105, does not include your human resources cost or resource required. But it is a function of it. If your headcount goes from 100 to 200, you will. And it is the heads that benefit from the human resources. It's the equipment that benefits from the equipment maintenance. And there are measurables to be able to use the strong causality to assign the cost. Excuse me. For instance, this is just an example from the nursing home, from long-term care facility, of distributing a human resource. $300,000 in human resources cost. Just took the head count from each of the activities, towed them up, see the percentage of heads in each of the operations, and you could distribute costs. It's a perfectly acceptable way of using what we've got here is unweighted head counts. But you don't have to just use the raw unweighted items, as I refer to it here. There are situations where all heads might not be created equal, where all of the various measurables that you have, you look at and they're not equal. In this case, we had a situation where it worked out that each hourly individual probably needed twice the support out of HR as each salary individual. There's a variety of reasons. One, there's more turnover. A salary person would tend to come in and be there for 5 or 6 years. The hourly people came and went more frequently, so there was more in and out activity. They also had to worry about complaints about the amount they were paid in particular periods because they were paid hourly. The salary people got the same amount every month, every 2 weeks. So they would weigh that. They would say every salary person only is twice as requires half the support as every hourly person. So you could go through the same kind of a process, just put a little weight on each head and distribute the cost a little differently, still based on the strong causality of it being head count. You can see how it would vary. Again, there's multiple ways to use these kind of things. This was another example from maintenance. Obviously, if you have a maintenance department and a bunch of different kinds of equipment, every hour of operation doesn't necessarily drive the same intensity of maintenance effort. You've got a complicated machine versus a simple machine. The one might require more maintenance every hour it operates than another. You can use the weighting process here. It's basically got a variety of categories and uptimes. You can modify the intensity using the weighting factor and distribute the cost appropriately. Again, this is one of the ways to be able to use strong causality to distribute costs throughout an organization. Weak causality, on the other hand, can be used to assign costs to support resources that require the support when it can be inferred, but there's no measurable quantity, or maybe materiality just makes using quantities overkill. Again, sometimes there are strong causal relationships and things you can measure, but the amount of money you're talking about is not worth the effort. So materiality would make you sort of take a little shorter cut involved. One way to look at weak causality, if it is example here, is manufacturing companies' purchasing activity. It accumulates about $300,000 worth of costs. We know it's related to the stuff they buy, but there's not really a strong measurable to assign it to the various things they buy because they're so different. So we can just use the best estimates of the most qualified individuals to take that cost and spread it among the appropriate things. Again, what we're accomplishing here is we're getting the cost of purchasing to things that are purchased. We're not sticking it in a general rate that goes all over the place. We're getting it to the right stuff. You can use the weak causality to approximate how it gets to the right things within the right stuff, if that's a nice scientific way to describe it. Again, we know that there's more for their decorative plastics effort than there is for the resins. That's taken into account. Whether the percentages are precise is not important. It's important that here you're assigning it to the stuff that causes it. You can infer that purchasing is related to the things that are bought, and you're coming up with the best estimate of the most qualified individuals to assign it to the specific items. Again, sometimes it's even simpler than that. Here's an example where, again, we have a company that does $500,000 worth of product engineering, and they have 2 product lines that are equal. Each one's about $10 million. But 80% of the product engineering supports one product line, and 20% of it supports the other. So there's 4 times more to support one than the other. Again, not immeasurable. It's overtime. The guys don't keep time cards and specify as they're working in product engineering or what everything they buy is attributable for. But you can get a feel for the 20/80 in this case. And the 20/80 is not because of the 20/80 rule. It's basically, that's basically how It broke down based on the estimates of the people who do product engineering in support of the two product lines. And that can be important to understanding your product profitability later. So again, it's weak causality, but can be inferred, and you can get a good estimate to link it to the appropriate stuff. Then you got strong causality and assignments, where we're going to take it, then assign it to the managerial or cost objective. And you have the usual suspects of the transactions that a lot of people use: the direct labor hours, the direct service related costs, machine hours, equipment hours, those kind of things. But there's also a myriad of other kind of things that you could use. Long-term care facility we talked about, we come up with cost per resident days by each of the acuity levels within there. Contractor events, that's one that we used as a direct way to assign the cost using strong causality at a tour management company. Every stop along the way, they have to get local contractors, and there's a lot of administrative effort related to every contractor at each stop. And so we were able to assign those to specific things based on contractor events. A distribution company would have line items picked. Every line item you have to pick, you have to move from location to location, and that's a driver of your cost. And so when you assign the cost for each line item picked, you can take into account the fact that there's a lot more cost involved in picking one of 10 different line items as opposed to one of 10 of one line items. Again, in-process moves at a manufacturer is another one, the ATM transactions at a financial institution. Again, you find what's appropriate for the organization, and there'd be measurables to be able to assign them to whatever your managerial or cost objectives are. But you can also use weak causality to attribute those things where we've got the inferred costs without having a direct way to measurable the output. Again, associating the resources and activities involved in marketing to customer A only to the sales to customer A. Sort of in our little example earlier, associating the resources involved in supporting product line one with just the product line one's costs. Or associating the extra costs in dealing with your jerk customers only to the products or services provided or sold to your jerk customers. Again, to understand the profitability of customers, product lines, and so forth, it's important to understand those costs. When it comes to certain decisions, it's also important to be able to assign those costs. Not always, but sometimes. Again, you need some caution when you get into this area. There are some decisions for which the assignment of these costs or these associated but not traceable costs is essential. But there are others where it's irrelevant or could even be deceptive if you take it wrong. As John Maurice Clark pointed out 100 years ago, there's different costs for different purposes. It's almost as important, maybe it is as important to understand when and where to use each kind of cost as it is to be able to devise a model that measures them appropriately. Throw in at the end here a thing that makes these additional costs being assigned important in my view. It comes down to what's Hicks's third law of pricing, of the three laws that I developed while flying on airplanes and drinking scotch over the years. In pricing decisions, any costs that are not assigned to a product, service, and customer are subconsciously added as a percentage of those costs that are assigned. And when you think about it, any cost you don't assign, basically you say, well, it's covered in the margin. You know, if you don't assign product support cost, if you don't assign customer support cost, if you don't assign the additional costs that are incurred by jerk customers, if you don't take those and incorporate them into the items you sell to those people or the services you provide to those people, you're assigning them as a percentage to everybody's total cost. Because that's where that's the total cost is a number you use as a basis for determining what the margin is. And so whenever people say to me, we don't assign those, we cover it in the margin, I'm saying, no, you're adding it as a percentage of total cost if you're equating it with the same basis you equate the margin with. So again, it can be important in coming up and making a pricing decision. You can use those to develop what we call tack-on rates. Basically saying we're going to take the 20% of the $100,000 we assigned to product line A, and the 400 we do to product line B, and turn it into a tack-on percentage to add to the items in those product lines. That way, when we're doing pricing, we're assuming the pricing of those products does cover the cost of being and supporting those kinds of products. Again, you gotta be careful when you do that and not take implications that it might make if you're not careful with it. So the last thing on there would be one of my pet things on causality that people look at. And that's that even for weak causality, the base you use matters. You've got the traditional way of looking at things, and you've got sort of maybe an alternative. Let's just take example of a company that spends $1 million on things they buy from outsiders, and they perform $1 million worth of internal activities in order to turn it into a product or service where the total cost is $2 million. So they incur $2 million, $1 million of stuff they buy, and $1 million to support stuff they do. And then their general administrative expense is $200,000. Now in the traditional world, that would be turned into a 10% G&A rate to tack on to things. My alternative for people to think about is to treat it as a rate on the things that it's incurred to support, which are the activities you perform within the organization, which is a 20% rate, but the base is only the activities that performed. And to see what that means, we can look at the 4 items I have below, where you've got the first 2, output A and B. Each of them, we spend $7,000 performing the service or making the product. One just happens to have some outside materials we have to pay for, and the other one is using outside materials that we were given by the customer to work on. It would seem to me that you would have needed to support the same amount of your business being operated, regardless of which one of those you were making. Yet, if you use the total cost as a base, you would have a different G&A assignment for each one. If you use internal cost as a base, you would have the same assignment for each one. The question is, to what is SG&A attributable? Is it attributable to the dollars you spend for material, the dollars you spend for performing all the stuff you do inside your business, or both? Output C and D, get output C also has a $10,000 total cost like output A, but the 2 numbers are reversed. It's 7,000 of material and 3,000 of work performed. Again, you're doing a lot less work, you're running your company a lot less. Why would the G&A tack on be the same? If it's part of the cost of doing the business that you do, it's a lot more involved for product C or for product A than it was for product C. So again, the base matters. And so again, as you go through, you want to look at even the causality on these tack-ons, which again, as I mentioned earlier, you have to be careful what you use and the implications that you get from having used them. So again, those are some of the things with causality, how causality works in modeling. It's important to keep in mind that you need to reflect those cause and effect relationship if your models are going to reflect economic reality. And only if they reflect economic reality will they lead to good decisions. They need to be based on causality and how all the elements of an organization link together to lead it toward its financial goals. With that, I will sort of end my shtick and open it up for questions or comments.
Doug, this is Larry. A few things kind of came up as I was monitoring the chat. I see we have another one that just came up. So the first one question came up about where can people get an explanation of all the concepts of causality that you mentioned early on, and I just took a moment to look it up because I always forget the name of the SMA, but there is a statement of management accounting by the Institute of Management Accountants that does explain in detail all the various concepts associated with causality. It's called Costing System Attributes that Support Good Decision Making, and it's available on the IMA website.
Mm-hmm.
So
And the conceptual framework of managerial costing also has, as part of it, a good explanation of those.
It does, but the one I mentioned is extremely detailed with examples. Let's see, we have another question that just popped up. I'll go to it. The question is, and we might need some explanation here, can we say that connectivity is an important step in inferring causality? There's a little bit more. Which methods are most suitable for the inference of connectivity and causality inference? I'm not sure. He mentions the word Bayesian networks, and Doug, you and I may not know what those are.
Yeah, those might be a little beyond our grade level.
So
again, connectivity, I'm not too sure the meaning of connectivity. Again, is it the same as the things are linked with the causality? Again, it's a difficult question to interpret at the moment.
okay, there's another question about isn't this just activity-based costing? How is it different?
Well, activity-based costing, again, is a method. Causality is a intricate, an important part of activity-based costing. But it's not, again, we're talking about the causality being used throughout the profitability and analytics framework. And based on a lot of the ABC I've seen, again, it primarily attempts to take existing cost and distribute it on down to get it to their cost objects. Again, they don't all run backwards and do projections extremely well. Some may, but again, it's the causality we need to have support the models that we use to understand the investment economics, as well as the revenue generating and revenue management type of economics. And it's fundamental principles in there. And again, within an ABC model, these same causality items would work, but they're not limited to costing, and they're not limited to, again, what's termed ABC. ABC's, in my mind, having written a couple of books on it, I try not to use the phrase anymore because it seems to limit the use of things as opposed to expand the use of things. I like to look at causality-based costing, which again, sort of expands the idea that anything you can link to the causality of items. But again, it is part of the fundamental structures, backbone of what ABC does.
Yeah, thanks, Doug, for that. That's a good explanation. We at the Profitability Analytics and with the conceptual framework, we try to stay away from methodologies and advocate that you apply the principles and the concepts of the conceptual framework to any particular method you're doing, and make sure it's covering those that are most important to your organization and the decisions. There's a question on causality for products and services. Does it make any difference? Of course, statutorily, GAAP has definitions of product costs, and service costs are far less required. So how does causality, is there any difference between causality for services and products in your view?
From a internal decision-making standpoint, there's not. From a financial reporting standpoint, no causality is necessary at all. That's why we have, in manufacturing, we have overhead rates based on direct labor, and that's why we cap and limit the kinds of costs that can be incurred in them. And we use financial costs like depreciation, which is one of the most, I've often called it the dumbest concept in managerial accounting, numbers that you can incorporate in the cost. So again, financial accounting, you don't even need this stuff. But for modeling any kind of manufacturing or service business, the same principles that I've just described fit them all, because you do need to understand, you have a portfolio of business if for no other reason, and you need to understand over time how that each item in that portfolio provides a return to the organization as a whole. You need to manage that portfolio. And if you have a variety of services, a variety of products, a mixture of products and services, you need over time to be able to understand those. And then if you want to improve them, you need to actually understand why what happens. And so causality is a way to be able to map out how you thought it was going to happen, to be able to then match that against what actually happened and get some answers and do that organizational learning.
There are a bunch of questions in the chat areas.
I'm
read one of them.
Yeah.
I have a good idea of the difference between cost traceability by causality versus attributed in the absence of measurable causality. The term assignment is used sometimes. Is something different meant?
Well, I think when people talk about assigning cost, to me, it's either way you're assigning costs, whether you're doing it with a percentage tack on, sort of the inference kind of way that I talked about it, whether you're doing it with a best estimates, if you're distributing the cost, or whether you're using a measurable. To me, that's a general term as you're assigning the cost. This just sort of narrows it down to the strength with which you can assign those costs and the strength of the relationship between the resource, the cost, and the thing you're assigning it to.
I'll add that when we wrote the conceptual framework for managerial costing, we strictly avoided the word allocation because that word is so closely assigned with financial accounting and very general non-causal assignments. So we tend to use the word assignment, and then it really goes to what Doug said, the strength of the assignment.
Yeah, we've always considered allocation a 4-letter word, and carry a bar of soap around to make people wash their mouth out after they use it.
Yeah, there's another question. Is it difficult to establish causality in the service sector, say in banks, insurance companies, and financial institutions? And then asked for your experience. And I will say there are a number of people on the call that I know that have experience in this sector. If you want to reach out to the person who asked this question in the chat and let them know. But otherwise, Doug, do you have any comments on the service sector?
Yeah, I would say it's if you get down and think through the process carefully. One of the things that happens with manufacturing is a lot of people do the stuff in manufacturing. And so you get to, you go to your cupboard and you open it up and you see the usual suspects, and then you match them against manufacturing, and you can get to the causalities quickly. If you go into a service business that hasn't done a lot of it, they're still there. You just got to go through the thought process of how does the things that we have as outputs cause us to do things, and how do those things then set off the chain of activities? Again, when we've done nursing homes, the examples I gave from non-manufacturing were some of the places we've actually done over the years with the long-term care facilities, tour management companies, banks, insurance, forced insurance companies. They've all been able to be places where you could develop those cause and effect relationships, to be able to do both the projections and understand how each of the different services they provide fits in their overall portfolio of business. So again, it's not necessarily as straightforward, simply because they probably haven't been done as often, and you don't have as many examples that you can pull out of your cupboard or out of the past inventory. But using the same logical thought process, you do come up with them, and they exist, I think, everywhere.
I notice we're at 12 o'clock. There's one more question here, Doug, that I think you'll kind of enjoy answering. It's very practical. In your experience, what is the most practical method or way to determine activity intensity factors for a small business to best model a cause and effect relationship? Then he suggests interviews, ? Breakout sessions, ? Other ?
Well, what we've usually done, because I deal primarily with small, mid-sized kind of businesses, is you determine who is the most qualified person to be able to give you the answer. And if there's a few, you ask a few of them separately and compare their answers. But again, in weighing things, you're not looking for precise measurements, you're looking for relative measurements. The weighting process I talked about during the session is one of the ones that we use the most often to be able to take into account things that are important to take into account, but not necessarily important to be precise down to 6 decimal places. But interviews is usually the way we go. I guess if there was something where there might be a little controversy, you might get a group together and have them hammer it out. But we basically haven't run with that. Usually those effort intensities, there's a person or two within an organization that you can trust to give you an educated estimate of.
Okay. Rafe, do you see any other questions we should immediately deal with, or should we pay more attention to the clock?
Well, why don't we just go for one more? There's a couple related about how you would go about measuring or quantifying causality for use in modeling. They say correlation may be simpler, although conceptually different. Would correlation be a simple proxy for causality, simply from a modeling point of view? I think that goes to the heart of your presentation today.
Yeah, correlations are dangerous. I would always look for, if you see a correlation, I would always go to see if there is actually a causal relationship behind it. One of the problems that evolved over time, as I've seen it, is that some of the old costing models were built on things that were correlations, but they were easy to do, and data handling was difficult. And so people saw a correlation between labor and overhead and those kind of things. And then over time, people used that, never understanding that it was a correlation. There maybe is no relationship, and it was only done because it was easy. And you just keep perpetuating it because that's what they did last year. And you wind up in the world changes, but your methodology doesn't change because you don't know what it was based on in the first place. And so correlation, there may be a correlation for a period or two, but it may disappear, and because you don't have causality, you won't know that it disappeared, and you'll keep using it. So I would always try to drill down and find the causality, and just correlation can lead to some tremendous errors when the world changes and you're still using that correlation.
Thanks, Doug. That's great. I just wanted to remind everyone that PACE's next webinar will be April 6th. It'll be on measuring and managing customer profitability, presented by Gary Kokins. It should be very interesting. We will be sending out the webinar information within the next week. Thanks, everybody, for attending today.
Yeah, thank you.